Welcome to the Friday afternoon edition of Brian's Briefs for Friday, July 31st, 2020. Let's get started. Let's talk about some of the data that came out today. There was quite a bit that came out this week, and a lot of that actually came out today. Personal income was down by 1.1% for the month of June. For the month of May, it was down by 4.4%. So while it was declining, it's not declining at as quick a rate as it had. Personal spending was up by 5.6%. Prior to that, it was up by 8.5%. Now, if you notice, spending seems to be doing better than income. When the virus first started, when the coronavirus first affected our economy, people were putting away their money and not spending as much. Now it seems to be the other way around. So people are getting a little bit more confident. That could be stymied, and I'll tell you why here in just a moment. PCE prices, which stands for personal consumption expenditures, was up by 0.4%. Prior to that, it was only up by 0.1%. It's still well below Fed targets. But the reason the Fed likes the PCE prices as a gauge of inflation is it measures how consumers spend their money every month. If coffee gets too expensive to buy tea, I know I repeat that example every month, but it's the easiest way to understand it. The Consumer Price Index, CPI, is based on a fixed basket of goods, and while it's a little bit more visible and a little bit more talked about, CPI measures spending habits like they would buy the same goods 20 years ago, whereas PCE is flexible and fluid, and the Fed likes that better. PCE prices without food and energy was up by 2.2%. In June, the previous month in May, it was also up by 0.2%, so not much of a change. The Employment Cost Index proves that even in a slow economy where employment is scarce or hard to come by, the cost still rises. The actual unemployment cost index was up by 0.5%. For the second quarter. Prior to that, in the first quarter, it was up by 0.8%. Chicago Purchasing Managers Index was at 51.9. Last month in May was only 36.6, and being above 50 denotes optimism. So the Chicago Purchasing Managers, they're fine bunch of fellows, if I do say so myself, are more optimistic now about the economy. University of Michigan Consumer Sentiment, the final read for the month of July. University of Michigan gauges consumer sentiment, surveys consumer sentiment based on the month in which they report. So for the third and final report for the month of July, because July is over pretty much, 72.5 was the number, 73.2 was the number last week, that was the estimate. So still pretty much in line. Let's talk about some of the data that came out earlier in the week as it pertains to real estate and mortgages. Durable goods orders, and durable goods are by definition goods that are ordered that are expected to stay in use for 3 years or more, was up by 7.3%. The prior month, in the month of May, was up by 15.1%, so slowing down, but still moving forward. Durable goods without the transportation index for the month of June was up by 3.3%. Prior to that was up by 3.6%, so pretty steady. S&P Case-Shiller Home Price Index, which measures home prices on a national level in 20 major markets on a year-to-year basis, was up by 3.7%. For the month of May, for the month of April, was up by 3.9%. So slowing down a little bit, but still pretty reasonable considering the economy that we're in and the employment index that we're looking at. Consumer confidence. This is what I was talking about before. Now this is not the University of Michigan. This is the Fed's gauge of consumer confidence. For the month of July, hit 92.6 on the index scale, very, very strong. 98.3 was the prior month, approaching 100, and while you theoretically could be at 100, it's very rare that numbers are this high. The MBA mortgage application index dropped by 0.8%. Prior to that, it was up by 4.1%. 4.1% is what I said. For that was for the week of July 25th. And this is kind of a volatile index. I know that even in my own regard, being in the business, it's volatile one week to the next, how many applications we take, how many people we pre-qualify. Pending home sales, something that should interest most of you watching my little presentation here, were up in the month of June by 16.6%, which seems like a strong number. It is a strong number, but the prior month in May was up by 44.3%. So pretty solid numbers overall. The Fed came out on Wednesday and said that the progress or removal of this virus as a point in the economy is going to make rates move up or down. If the virus strengthens and the economy slows down, rates will move down. If the economy picks up because the virus has come down, rates will move up. And they don't expect, really, the people I read, the prognosticators I read, do not expect the Fed to change that rate, that range from 0 to 0.25% on the Fed funds. They expect it not to be changed for many years to come. I didn't say days, I didn't say weeks, I said months, I said years to come. That's the relative consensus thinking right now. Initial claims for unemployment came out yesterday, 1.43 million people. Prior to that, it was up by 1.4 million. So holding steady, and that's a high number. Doesn't seem such a high number because we've been over a million for some time, but it used to run 180 to 200,000 in a week. It's much higher now. Continuing claims, which is a 4-week moving average of initial claims, is sitting at 17.01 million right now. Prior to that was 16.15 million. The worst quarterly measure of GDP on record came out today for the first month of the second quarter, and it was down by 32.9%. Just a horrendous number. They think that it's only going to get better from here. We'll find out. We'll see. But 32. Now, when I say the worst on record, keep in mind that's the worst since the Great Depression, the Great Recession, worst ever. There was never a number that bad, even during the Great Recession, but it was down by 32.9%. So I hope I haven't depressed you too much. The chain deflator, which is a measure of inflation within the GDP, was down by 1.8%. Prior to that, it was up by 1.4%. That's for the second quarter. We're only 1 month out of the second quarter. We'll get another estimate a month from now for the second quarter, another estimate a month from now for the second quarter. When the third quarter, which we're currently in, ends, then we'll get 3 consecutive estimates for the third quarter. That's the way it works. Okay. And you know what? That's all the data I have. You're probably relieved. The 10-year yield fell below 0.6% for the first time ever. It landed today at 0.56%. And the Fed is still buying mortgage-backed securities with the idea of keeping mortgage rates low. They're spending on average right now about $4.24 billion a day in mortgage-backed securities. When this first hit, when the coronavirus first hit, they were buying $50 billion a day. So they're only buying 8.5% of what they used to buy. But as I said, rates are at all-time lows. So they get more bang for their buck, more power to them. That's about it for this week. Hope if you have any questions, I hope you feel free to give me a call at the number or the email below my video here. And check out the Kiplinger letter for July 31st. It's very got a lot of insight, and it's free to you because you listen to my briefs. Thanks a lot. Have a great weekend, and talk to you soon. Bye-bye.